Good afternoon, everyone. Let's run through the latest on US inflation, crude oil, and gold prices, and what's shaping their near-term outlook. So starting with US dollar. The July CPI numbers came in broadly as expected. The headline CPI rose 0.2% month-on-month, holding the annual pace at 2.7%. And core CPI climbed at 0.32%, lifting the yearly rate to 3.1%, which is the highest since February. This shows inflation is still moving in the wrong direction for the Fed, even as the labor market shows signs of cooling. So given these pressures, we expect the Fed to cut rates by 25 basis points at each of the next 3 meetings, but not beyond that unless the employment weakens more sharply. And moving to WTI crude oil. WTI crude oil slipped to 62.6 and testing the lower end of the recent range. The EIA's latest outlook lifted US production forecast for 2025 and 2026 and predicted Brent could drop to $50 by early 2026 as OPEC ease quotas and global inventories grow. And Trump is positioning himself as a mediator in Russia-Ukraine talks, but markets see a little chance of a quick breakthrough. Rising supply forecasts and inventory builds are keeping the short-term sentiment cautious. And last but not least, the gold. Gold is steady about $3,300 per ounce, supported by slowing US jobs growth and persistent inflation. And we expect the average prices to reach $3,400 in Q3 and $3,450 in Q4, with a break above $3,500 likely in early 2026. And our forecast now calls for 3 Fed rate cuts this year and 2 early next year, which is a faster pace than markets currently expected, which should continue to support gold's bullish trend. So to wrap up, the US inflation remains sticky, limiting Fed policy room, and crude oil is under pressure from supply growth, and gold retains a strong upward momentum as rate cut bets build. So that's all for today, and I will see you in the next update.